Hello, everybody. This is Harjinder. We will talk about Chapter 9, Budgeting, in this video. The learning objectives for this particular topic or chapter include the ability to explain the use of budgets by organizations, to describe and apply the master budget process, and the ability to prepare a flexible budget. So first of all, why are budgets used in organizations? Budgets are important planning tools. They're used by management to communicate financial objectives about the future, to allocate resources, and to coordinate activities across various functional areas within the organization. They also help in comparing actual performance to what was planned. So that means they can help in the control function and to take corrective action as needed. So put together, budgets help accomplish dual roles of planning and control. What are some of the advantages of budgeting? First, budgets help communicate management plans throughout the organization. They force managers to think about the future as well as plan for it. Budgets act as a means of allocating resources throughout the organization. They can help uncover possible bottlenecks within the organization so that changes can be made if these bottlenecks are identified. Budgets can help coordinate activities within the organization by integrating plans of various areas within the organization. And finally, budgets can also serve as benchmarks for evaluating actual performance against what was planned. So there are two broad approaches to budgeting. One approach is called participative budgeting. Now, under participating budgeting, managers prepare their own budget for their own area of supervision, and that budget is then reviewed by the supervisor or the officer that the manager reports. And what sometimes ends up happening is people, for usually for reasons of being cautious, they tend to understate the possible performance, and that can result in what is known as budgetary slack. For example, a manager may be confident of being able to, say, sell 100,000 units in a year. However, in order to protect himself or herself from the possible chance that sales might not be as hoped, might only budget for 80,000. So what ends up happening is if the manager is able to deliver 100,000 units of sales, it would appear that the particular division outperformed the budget, whereas the manager had been confident all along of being able to sell the 100,000 units. So the gap between what the manager actually is confident of achieving and what the manager puts down on the budget, that's called budgetary slack. Another approach to budgeting is top-down budgeting. And what happens in this case is senior managers prepare budgets for their subordinates. Now, this creates the trouble of possibly lack of buy-in from the junior managers or people within the organization who may feel that they were never consulted, that they never had any say in the preparation of that budget. Here's a look at the master budget process. To the right of the screen, you'll see the all the steps that form a part of the master budget process. We typically begin with a sales budget, which includes a schedule of cash collections during the period. The sales budget provides inputs needed for the production budget. The production budget then informs the preparation of the direct materials purchase budget. And along with the direct materials purchase budget, we make a schedule of cash payments to suppliers. We also prepare a direct labor budget based on the production budget and a manufacturing overhead budget. We plan for the ending inventory as well. Um, how much would be the amount of ending inventory remaining at the end of the year, considering what we are going to be producing and what we hope to sell. We make a selling and administrative budget. And all of these budgets earlier help prepare the cash budget. The cash budget is a very important document because it helps the management foresee when, in which period, in which month or quarter, the business may have need for cash borrowing, and in which periods there might be additional cash available, so that they can plan um, the uses of cash and sources of cash. All of the above inputs help prepare a budgeted income statement, which is also called a pro forma income statement, and a budgeted balance sheet. Let's take a look at the sales budget and the schedule of cash collections. First off, the sales budget. The sales budget, as you can see, outlines the number of units that are expected to be sold during the year. In this particular example, a budget has been prepared on a quarterly basis. A more detailed budget might be for the 12 months in a year. You notice here the budgeted sales in units, if multiplied by the selling price per unit, gives us the budgeted sales dollars. So notice here how the budget has been prepared on a quarterly basis, quarter one, quarter two, quarter three, quarter four, and then for the entire year, this is the $6 million is the total budgeted sales. Now, usually companies make sales on credit, and collections will follow a certain pattern. So for this particular company, they have a collection pattern as is shown at the bottom here. Cash collections from sales are as follows. 60% are collected in the quarter of sale. The remaining 40% is collected in the following quarter. So quarter one for the current year, 2015, the company will collect 60% of the sales. So 60% of 600,000, that's 360,000, as you can see. But they also happen to collect the amount not yet collected from the previous quarter. So you notice here the first asterisk, cash collections from last year's fourth quarter sales. The details are, of course, coming from the previous period's balance sheet. Each month, you can see the pattern of collection being an amount collected for the current quarter and an amount collected for the previous. Now, thing to keep in mind is we must adjust for any expected bad debts. If, let's say, there is an expectation that a certain percentage may not be collected because of whatever, poor collection policies, et cetera, then that amount of expected non-collections are to be included as a selling and administrative expense in the selling and admin budget, and it's a non-cash item. Here's a look at the production budget. So as you can notice here, the production budget is based on budgeted sales, every business typically will maintain a certain amount of safety inventory. So for this particular company, this company likes to maintain an inventory level of 10% of the next quarter's sales. For quarter one, the company intends to sell 20,000 units. In the following quarter, the company hopes to sell 60,000 units. So for quarter one, the company needs the 20,000 units that it's going to sell in the current quarter, but it will also want to end the quarter with 10% of the following quarter's sales. So 10% of 60,000 is 6,000. So the company needs a total of 26,000 units. Out of the 26,000 units, the company will have some beginning inventory. Ending inventory from the previous quarter becomes beginning inventory for the current. So the total production needed is the difference between the total inventory needed, the total number of units required for the quarter to cover the budgeted sales and the required ending inventory, minus the beginning inventory. So we're going to take a look at an example. This is an example from the textbook, exercise 9-2. And the story is you're given information about a company called Grabber Corporation. You've been given a sales forecast for 4 quarters in the year. And the thing to keep in mind is that the sales dollars per quarter will simply be the number of units expected to be sold multiplied by the selling price per unit. The next piece of information tells you that the selling price of the company's product is $22, and management expects to collect 75% of the sales in the quarter in which the sales are made and 20% in the following quarter. 5% of the sales are expected to be uncollectible. So remember, I was talking about possible bad debts. This company expects 5% of sales to be uncollectible, i.e. bad debt. The beginning balance of accounts receivable, so that would be the amount not yet collected as of the 4th quarter of the previous year, all of which is expected to be collected in the 1st quarter, is $66,000. The company expects to start the 1st quarter with 3,200 units in finished goods inventory. Management desires an ending finished goods inventory in each quarter equaling 20% of the next quarter's budgeted sales. The desired ending finished goods inventory for the 4th quarter is 3,400 units. So given that the desired ending inventory is 20% of the next quarter's sales, we will take that into account when we prepare the production budget for the fiscal year, the upcoming fiscal year. We're also going to be preparing a sales budget and a schedule of expected cash collection. So here you can see on the screen, we have the sales budget for Grabber Corporation. We have 4 quarters, quarter 1, quarter 2, quarter 3, quarter 4, and a column for the total for the year. The budgeted unit sales were given to us in the question. 16,000 units in the 1st quarter, 15,000 in the 2nd quarter, 14,000 in the 3rd quarter, and 15,000 units again in the 4th quarter. That works out to a total of 60,000 units for the year. The company's selling price per unit is $22. So 16,000 units expected to be sold in the 1st quarter, multiplied by $22 a unit, gives us budgeted sales of $352,000 for the 1st quarter. For the 2nd quarter, that's 15,000 units times $22. For the 3rd quarter, 14,000 units times $22. And for the last quarter, 15,000 units times $22. The total for the year is 60,000 units times $22, 1,320,000. You can also check that by adding up the individual sales dollars for the 4 quarters. It is indeed 1,320,000. Now you're going to use this information to prepare a schedule of expected cash collections. So in the problem, we were told that the accounts receivable at the end of the previous quarter were $66,000, and all of it is expected to be collected in quarter 1. So you will include the beginning accounts receivable. Next, you will look at the collection pattern. The problem told us that the company collects 75% of each quarter's sales in the quarter itself. So in quarter 1, the budgeted sales dollars are 352,000. 75% of 352,000 will be collected. So 75% of 352,000 is expected to be collected in quarter 1. 20% of the 352,000 will be collected next quarter. The remaining 5% is expected to be uncollectible, and it will be added as a bad debt expense in the selling and administrative budget. You're not preparing a selling and administrative budget for this problem, but if it was a master budget exercise, you will include the bad debt expense in the selling and administrative budget. Likewise, for quarter 2, the total expected sales are $330,000. 75% of that will be collected in quarter 2 itself. 20% of 330,000 will be collected in quarter 3. The remaining 5% is bad debt expense to be included in the selling and administrative budget. Notice the pattern. Each quarter, we're collecting 2 pieces, 2 parts. 75% of the current quarter's sales and 20% of the previous quarter's sales. This pattern will continue in quarter 3. 75% of 308,000 will be collected, and 20% of the 308,000 is collected in quarter 4. In quarter 4, we collect 75% of 330,000. The remainder will be collected next year in quarter 1 of the following year. We are not making a budget for the following year. Now, if you were to add up, we collect 1,254,000. That's the expectation. And in each quarter, the amounts collected will be 330,000, 317,900, 297,000, and so on. You can confirm if you add together the cash expected to be collected in each of these quarters, it works out to 1,254,000. Next, we'll prepare a production budget. So for the production budget, we need the budgeted unit sales. These were given to us in the problem. That's our starting point, budgeted unit sales. This company's policy is to maintain 20% of the following quarter's sales. So at the end of quarter 1, the company would like to have ending inventory equal to 20% of the next quarter's sales. So 20% of next quarter's sales, 20% of 15,000 works out to 3,000. The company wants an ending inventory for Q1 to be equal to 3,000 units. So how many units does the company need in total? Well, they are hoping to sell 16,000 units, and they want an ending inventory of 3,000 units. So total inventory required is 19,000 units. Now, this company would have begun the year with some inventory on hand. In the problem, which this was given to us to be 3,200 units. Now, notice 3,200 is nothing but 20% of 16,000. So this company has a stable policy of maintaining ending inventory. So fourth quarter of the previous year, they knew that they were budgeting to sell 16,000 units in Q1, so they would have endeavored to maintain an ending inventory equaling 20% of 16,000 units, and hence came the 3,200 units of beginning inventory. Now, 19,000 units needed in total, of which 3,200 units are already there. The company already has 3,200 units. So how many more do they need to produce? Well, that's the difference between the total units needed and the beginning inventory. 19,000 minus the 3,200 units of beginning inventory works out to 15,800 units that must be produced in the first quarter. All right. Likewise, you will fill in the information for the following quarters. So in Q2, we expect to sell 15,000 units. We would like to maintain an ending inventory of 20% of 14,000. That's 2,800. Total units needed 17,800. Beginning inventory for Q2 is nothing but the ending inventory from Q1. That's 3,000. So number of units to be produced in Q2 is 14,800. In quarter three, we expect to sell 14,000 units. 15,000 units is the expected sales for Q4. We want to maintain an ending inventory equaling 20% of Q4 sales. So that's 3,000 units again. 14 plus 3, we need a total of 17,000 units. Beginning inventory for Q3 equals the ending inventory from Q2. That's 2,800 units. So units to produce will work out to 17,000 minus 2,800, 14,200 units. Now in the problem, they gave us that the desired ending inventory at the end of the fourth quarter is 3,400, which would be 20% of the next year's first quarter sales. The number is given to us. So 3,400 plus the 15,000. We need a total of 18,400 units. Beginning inventory for Q4, 3,000 units. So number of units to produce in Q4, 15,400. So what's the total number of units to produce for the entire year? You can get that number by adding together the number of units to be produced in each of the quarters. Works out to 60,200. Now, when you make the totals column, you have to be a little careful. So this is the totals column for the entire year. So the company is budgeting to sell 60,000 units in the entire year. Now, for the year, the company's required ending inventory is 3,400, because remember, the year will end with Q4. So at the end of the fourth quarter, the required ending inventory of 3,400 will automatically become the ending inventory for the entire year. So 3,400 units is the required ending inventory for the year. Total inventory needed, therefore, for the year is 63,400. Now, the year began with the beginning inventory for the first quarter of 3,200. That is also the beginning inventory for the whole year, if you think about it. We began the year with 3,200, total units to produce, 63,400 minus the 3,200, or 60,200 units. Be very careful with the totals column, as I said. Next, we're going to take a look at the materials purchase budget and the schedule of cash payments. For the materials purchase budget, our starting point is the required production in units. Each unit to be produced will need a certain amount of raw materials. In this illustration, the company produces some kind of fabric-based product. So they need 1 meter of raw materials for each unit. So multiplying the requirement raw materials needed to produce 1 unit works out to gives us the production needed, the raw materials needed for production. you can then proceed to the next part. The company also has a policy for maintaining a certain required ending inventory. This company maintains a 10% inventory for the next quarter's production requirements. You notice the ending inventory is equal to 10% of the next quarter's production needs. Added together, we get the total raw material needed in any given quarter. From that total raw material needed for any given quarter, subtract the beginning inventory, and you'll get the quantity of raw materials to be purchased in each quarter. That quantity multiplied by the raw material price for each meter, here it's $4, will give us the raw material purchase cost. Companies will typically not pay cash right away for their purchases. They buy on credit, and they typically will have a staggered payment system. So for this company, their payment system is they pay 70% in the quarter of purchase, and the remaining 30% is paid in the following quarter. So bottom line, you have to keep in mind that we first need to calculate the units of raw materials needed, and then we can get the equivalent dollars. The schedule of expected cash disbursements is based on the raw material purchases in dollars, and it's apportioned based on how the company pays for its purchases. We are going to take a look at exercise 9-3, which talks about Microproducts Inc. It's a manufacturer of a calculator which needs 3 chips that cost $3 each, bought from an overseas supplier. The company has produced a production budget, and based on the production budget, the company will be producing 60,000, 90,000, 150,000, and 100,000 calculators respectively in each of the 4 quarters of year 2. And the plan is to produce 80,000 calculators in the first quarter of year 3. The chip that's used in production is sometimes hard to get, so the company wants to watch out against possible stockout, and so wants to maintain an inventory at the end of each quarter equaling 20% of the following quarter's production requirements. And we are told that 36,000 chips will be in stock to start the first quarter of year 2. What we need to keep in mind is that 20% is basically the desired ending raw material inventory. And we must prepare a direct materials purchases budget for the chips, which happen to be the raw materials for this particular company, by quarter and in total for year 2. So here on the screen, we have a direct materials purchase budget for Microproducts. And it's for the year ended December 31st, 2002. As you can see, there's 4 quarters. We were given information about the budgeted production numbers in units. We were told that these were the budgeted production numbers for each quarter for year 2. So that works out to a total of 400,000 units. And then in the first quarter of year 3, the company expects to produce 80,000 units. So you need that as a starting point. Each unit needs 3 chips. If you multiply 60,000 units by 3, then in order to produce 60,000 calculators in the first quarter, we need to be able to use 180,000 chips. Likewise, if you multiply the requirements for each of the following quarters, in quarter 2, 90,000 calculators are to be produced. Each calculator takes 3 chips. So that's going to need 270,000. 150,000 calculators, that's 450,000, so on and so forth. For the total production for the year two, 400,000 calculators will call for 1.2 million chips. The 80,000 units expected to be produced in the first quarter of year three will need 240,000. Why we are using the first quarter information will become clearer in a moment. This company also wants to make sure that it has sufficient inventory to cover 20% of the following quarter's production requirements. So not only does the company need 180,000 chips for the units to be produced in the first quarter, it also wants to make sure that at the end of the first quarter, it has ending inventory of chips equaling 20% of the number of chips that it will need to ensure production in quarter two. So the total number of chips needed in quarter two is 270,000. 20% of that is 54,000 chips. So adding the 180,000 chips needed for the current quarter's production and 54,000 chips needed as sort of safety stock, 20% of the following quarter's production, gives us total chips required 234,000. Now, the company would have started the current quarter. We were given the amount of chips that's 36,000. 36,000, as you can notice, is nothing but 20% of 180,000, right? So if this company is consistent in its application of policy, it would have ended quarter four of year two with 20% of 180,000 or 36,000 chips. So the company needs a total of 234,000 chips. It has a beginning inventory of 36,000 chips. So the difference between the two, 234,000 minus 36,000, 198,000 chips is what this company needs to purchase. And at a cost of $3 per chip, the 198,000 chips will end up costing 594,000. 198,000 chips multiplied by $3. Okay, so that was the first quarter. For quarter two, it's a similar story. The company needs 270,000 chips just to make sure that the production for Q2 is taken care of. And it also wants to make sure that it has a safety stock equaling 20% of Q3 production requirement. 20% of 450,000 is 90,000 units, chips, I mean. So total number of chips needed, 360,000. The company has beginning inventory. So last quarter's ending inventory is the beginning inventory for quarter two. 360,000 chips needed, 54,000 chips already in stock. How many do they need to buy? The difference. And at $3 per chip, that cost is $918,000. For Q3, they need 450,000 chips for the current quarter's production. Safety stock, 20% of 300,000, that's 60,000 chips. Total chips needed, 510,000. Last quarter's ending inventory is the current quarter's beginning inventory. So we already have 90,000 chips. So the number of chips to purchase is 510 minus 90, 420,000. At $3 each, that works out to $1,260,000 worth of chips to be bought. In Q4, the company needs 300,000 chips for the production. It wants to maintain ending inventory equaling 20% of the next quarter. Now, the next quarter is basically Q1 from year three. So in Q1 from year three, the company will need 240,000 chips in total. 20% of that, the ending inventory needed for Q4 is 20% of the next quarter's production requirements. So that's 48,000. Total added together, the company needs 348,000 chips. The beginning inventory for Q4 will be 60,000 chips. The chips to be purchased, 288,000 at $3 for each chip. That works out to $864,000. When you're making the totals column, again, I'd caution you, be careful. We're looking at the entire year. So in the entire year, the company is looking to produce 400,000 calculators and will need 1.2 million chips in total. The company also needs to make sure that it has ending inventory equaling 20% of the next quarter's production. So that ending inventory is basically nothing but the ending inventory for the fourth quarter, 48,000. Total inventory needed of the chips is therefore 1,248,000. The company began the year. So the year started, remember, in Q1, and they had beginning inventory of chips, 36,000. That was the beginning inventory for the year, 36,000. So for the year, the company needs to purchase 1,248,000 less 36,000 or 1,212,000. You can confirm that answer by adding together the number of chips to be purchased in each of the four quarters. It is indeed 1,212,000. At $3 each, the dollar value of the chips to be purchased is $3,636,000. Next, we take a look at the direct labor budget. And for the direct labor budget, the direct labor requirements are based on how many units will be produced. Each unit needs a certain amount of labor time. So in this particular example, each unit needs half an hour of labor time. So that's 0.5 hours. If you multiply the number of units that will be produced by the 0.5 hours needed to make one unit, you get the total direct labor hours needed for production. Multiply the total direct labor hours needed by the labor cost per hour, you'll get the total direct labor cost. We'll take a look at example 9-4, exercise 9-4. And in here, we have a company called Davison Enterprise, which has produced a production forecast for 4 quarters of the next fiscal year. And we're told that each unit needs half an hour of labor time and employees are paid $15 for each hour. Now, this question comes in two parts. The first requirement is to make the company's direct labor budget for the upcoming fiscal year, assuming that the direct labor workforce is adjusted each quarter to match the number of hours required to produce the forecast number of units. So the idea there is that labor is actually variable with production. This is not in reality a very tenable assumption because labor is not as flexible. Once you hire people, you have to give them the hours. Otherwise, qualified skilled laborers might just drift away, might go to a competitor. So to give you a more realistic feel, part 2 of the question says, assume that direct labor force is not adjusted each quarter, but instead the company's workforce consists of permanent employees who are guaranteed to be paid for at least 4,500 hours of work each quarter. Now, if the number of labor hours is less than the 4,500 hours, the workers will be paid for 4,500 hours anyways. If, on the other hand, more than 4,500 hours are needed, then the workers will be paid overtime pay, which is at 1.5 times the normal hourly pay. So this is like the second part is a more realistic example of how um, labor costs behave in countries like Canada. All right, so here we have a direct labor budget. So in part one, remember the assumption was that direct labor is adjusted each quarter to match the forecast production. So remember, we were given in the problem the number of units that are expected to be produced in each quarter. The total works out to 37,600 units. And we were told that the number of labor hours needed to produce each unit is half. So half an hour is needed to make one unit. You multiply 10,000 units by zero point 0.5, you get the total direct labor hours needed in the first quarter, 5,000, in quarter two, 4,400, in quarter three, 4,500, and in quarter four, 4,900, i.e. a total of 18,800 direct labor hours will be needed for the entire year's production. Workers are paid a wage rate of $15 an hour. So the total direct labor cost for the first quarter will be 5,000 hours times $15 or $75,000. And then likewise, you can calculate the direct labor costs for each of the following quarters and for the year. Now this, mind you, as I said, is um, it, it's a simplistic scenario where we believe that we can adjust the number of hours of labor time to match our production requirements. In reality, though, labor tends to be a little bit more um, sticky. Labor costs tend to be a little bit more sticky. And so that is actually illustrated in the second part, where we assume that direct labor is actually not adjusted each quarter to match forecast production. Workers are actually guaranteed 4,500 hours at $15. And if they need to work more than 4,500 hours, they actually get paid overtime pay at 1.5 times. So instead of $15 an hour, they get paid 1.5 times that, or $22.50 in overtime. So to make a direct labor budget in that case, well, we've already done the work for the number of labor hours needed. Yeah. So number of labor hours needed was basically the number of units to be produced multiplied by the direct labor time required to make each unit. So since we already have the total direct labor hours needed, I'm going to start with that. If we didn't have the information already prepared, we will have calculated it by multiplying the units to be produced by the direct labor time needed to make one unit. So we need these many labor hours. Now, regular hours that must be paid under the contract is 4,500. So regardless of how many labor hours are actually needed, workers will get paid for 4,500 hours. All right. After you've taken care of that, you must look at if there's any overtime hours. So how do we calculate overtime hours? You look at the total direct labor hours needed and the regular hours that we are paying our workers. So 5,000 hours needed in quarter one, 4,500 is our minimum commitment to them. So 5,000 hours is more than 4,500 hours. The difference is 5,000 hours. 5,000 hours worth of overtime needs to be paid. So what does that imply in terms of wages? For the 4,500 regular hours, we will pay our workers at $15 an hour. So 4,500 times 15 is 67,500. For the 500 overtime hours, we will pay our workers at 1.5 times the regular pay. So 500 hours times $15 is the regular pay. 1.5 times that works out to 11,250. Okay. So 500 hours at $15 times 1.5, 11,250. So total direct labor cost for the first quarter will be $78,750. In the second quarter, we only need 4,400 hours. We have a commitment to pay the workers for 4,500. So clearly there is no overtime to be paid. We're only going to pay the workers for the regular hours, 67,500, and that will be the total direct labor cost for the second quarter. In Q3, the total direct labor hours needed is 4,500, and we have a commitment to pay for our workers for 4,500 hours. So again, there will be no overtime in the third quarter. You will only pay for the regular hours. In Q4, the number of labor hours needed is 4,900. We regularly pay our workers for 4,500 hours. So the difference, 400 hours additional, is the overtime. So we will pay our workers for the regular time, 67,500, and for the extra 400 hours, we'll pay at time and a half. So $400 times $15 times 1.5 works out to $9,000. The wage cost for the fourth quarter is 76,500. Overall, it works out to a labor cost of $290,250. Next, we'll look at the manufacturing overhead budget. Now, the manufacturing overhead, remember, it's got two parts, the variable manufacturing overhead and the fixed manufacturing overhead. More often than not, the variable portion of manufacturing overhead is based on direct labor hours. It could also have been machine hours and so on if the production is highly automated. So in this example, the variable overhead is calculated based on budgeted labor hours. The fixed manufacturing overhead cost typically tends to be a fixed number. Adding the variable manufacturing overhead to the fixed manufacturing overhead, we get total manufacturing overhead. Now, for purposes of preparing the cash budget, we need to figure out how much of this total manufacturing overhead will actually be paid for in cash. So to get to that, remember, included in the fixed manufacturing overhead portion often is depreciation on the factory equipment. Now, depreciation is a non-cash item, right? You debit depreciation expense, credit the accumulated depreciation. That's what you do normally. In the case of a manufacturing company, you debit manufacturing overhead and credit accumulated depreciation. There's no actual cash paid out. So depreciation, because it's a non-cash item, we take it out. We subtract the depreciation cost from the total manufacturing overhead to get the cash disbursements for manufacturing overhead. That's a fancy way for saying how much of the manufacturing overhead will be paid for in cash. Now, when you add up the total manufacturing overhead costs for the year, you get 1,206,000 in this particular example. If you divide that by the total budgeted direct labor hours, you get the predetermined manufacturing overhead rate for the year. So in the next example that we're going to take a look at, exercise 9-5, we will work through the manufacturing overhead budget. So the company is Yuvwell Corporation, and we are given the budgeted direct labor hours for the company for the coming year. The variable manufacturing overhead rate is $3.25 for each direct labor hour. The fixed manufacturing overhead cost is $48,000 for each quarter. And included in the $48,000 for each quarter is depreciation, $16,000 per quarter. Remember, non-cash items must be excluded when we calculate cash to be paid. So we are asked to prepare the company's manufacturing overhead budget for the coming fiscal year and to calculate the manufacturing overhead rate for the coming fiscal year. So in the problem, we were given the budgeted direct labor hours for each of the 4 quarters. They added up to 32,500. Our variable manufacturing overhead is calculated at $3.25 for each direct labor hour. So in quarter 1, if this company expects to have 8,000 direct labor hours, then the expected variable manufacturing overhead will be $3.25 multiplied by the 8,000 hours, or $26,000. Likewise, for the other quarters, you can calculate the variable manufacturing overhead costs. The fixed manufacturing overhead cost is $48,000 in total for each of the 4 quarters. If you add the variable manufacturing overhead to the fixed manufacturing overhead, you get total manufacturing overhead costs for the year $297,625. Included in these costs are the costs of depreciation. Now remember, depreciation is a non-cash item. So when calculating the manufacturing overhead that will be paid for in cash, we need to subtract depreciation. The depreciation is $16,000 for each quarter, i.e. $64,000 for the year. So manufacturing overhead to be paid for in cash for quarter 1 will be $74,000, the total manufacturing overhead, minus the $16,000 of non-cash depreciation, or $58,000. For quarter 2, $74,650 minus the $16,000, $58,650. And likewise for the other quarters. Next, when you're calculating the predetermined manufacturing overhead rate, the total manufacturing overhead for the year is $297,625, and the total budgeted direct labor hours are 32,500. If you divide the total manufacturing overhead dollars by the total budgeted direct labor hours, we get a predetermined manufacturing overhead rate of $9.16 for each direct labor hour. Next, we're going to talk about the ending finished goods inventory budget, which is basically the number of units expected for the ending inventory multiplied by the average per unit product cost. In this particular example, the per unit product cost is calculated. The company uses direct materials costing $4 for each unit. The labor cost is $10 for each unit, and manufacturing overhead is $6 for each unit. That's a cost of $20 for each unit. The company expects to have ending finished goods inventory of 3,000 units at the end of the year. At $20 a pop, that works out to $60,000 worth of ending finished goods. Next, looking at selling and administrative budget. For the selling and administrative budget, again, selling and administrative costs can be variable or fixed. So for the variable selling and admin costs, those costs depend on the number of units sold. So there is a cost per unit based on the number of units sold. You multiply the cost per unit by the number of units sold to get the budgeted variable cost for the selling and admin. And then the fixed selling and admin costs would include all your selling and marketing and administrative related costs that are fixed in nature. including advertising, senior management salaries, insurance, property taxes, etc. Now, depreciation on the uh, administrative equipment is a non-cash item that needs to be taken out. Okay, so this particular example had a whole bunch of other adjustments. I'm skipping that for the moment. Big things to keep in mind, the selling and administrative costs are broken up into the variable portion and fixed portion. The variable selling and admin costs will also include bad debt expense. Okay, so if this company has any kind of uncollectible amounts, they are included in the selling and administrative costs. And when you're calculating the cash disbursements for selling and admin costs, you must deduct the non-cash items. Those non-cash items include depreciation and bad debts. And if there's any kind of prepaid expenses, they must be subtracted. So the idea there is to get the cash that will be paid for selling and administrative. Once you have produced each of these individual budgets, then you will be ready to prepare the cash budget. And the idea there is to be able to calculate if this company is going to end up with a cash excess or deficiency. So you start out with the cash balance at the beginning of the year. So that's the first quarter. You will add collections, the cash collections as per the sales budget to get the total cash available. From the total cash available, you'll subtract all the cash disbursements for direct materials, for direct labor, for manufacturing overhead, for selling and admin, etc., etc. And you'll compare the total cash to be dispersed to the total cash available. If the total cash available is more than the total cash to be dispersed, then there is an excess. If, on the other hand, the total cash to be paid is more than the total cash available, then the company is looking at a deficiency. So when the company has a deficiency, it implies a need to borrow. Then the company will have to borrow money. And when the company borrows money, well, money doesn't come for free. The company borrows money and must pay interest on it. So we have to calculate um, the interest amount. And in some cases, banks could also impose restrictions on how much can be borrowed. Sometimes we stylize it to include stuff like, oh, borrowing can only happen at the beginning of the month and so on. You also have to be mindful of the company's minimum cash balance policy. So that is a fairly complex piece, and we will be taking it up in a very comprehensive example in class, case 9-29. We'll be doing that case in class, and I want you folks to make sure that you read up on the case ahead of class. We won't have as much time to read the case during class. I'll actually want us to be working on the case. So please make sure that you read, at least do a skim read of the case before class. Next, I want to look at the performance report. So this is called a static budget performance report. So the static budget is basically what the company had planned for before the current year began. Now remember, what was planned is often not what was actually achieved. So if you take a look at the screen here, the company had a plan to produce and sell 200,000 units. They actually sold 220,000 units. So when we compare what happened actually to what was planned for, the differences are either favorable to the company or unfavorable. So for example, if the company's plan was to have sales of $6 million and the company actually managed to sell more than $6 million worth of goods, the difference is a favorable outcome for the company. On the other hand, if the company was hoping to spend $800,000 on direct materials and the company spent $869,000 on direct materials, the difference being a higher cost, a higher amount of cost is unfavorable. Now, the static budget performance report can give us a snapshot of what really happened compared to what we were planning. But if what really happened was not entirely in line in terms of the volume, so we were hoping to sell 200,000 units, and if the actual units sold is 220,000, well, then we don't have to be Sherlock Holmes here to figure out, hey, if you sold more units, you also had to make more units, and that will drive up your cost of direct materials, direct labor, so on and so forth. So, we need to compensate for that fact. So that part is actually captured better if we were to prepare something called a flexible budget. So again, the static budget is one that is designed for a very specific planned level of activity. In contrast, a flexible budget can adjust revenues and costs for any level of activity within a specified range. And this flexible budget is usually prepared when we are comparing actual results to what was budgeted. And what we do there is we adjust variable costs to reflect the actual volume of sale. Of course, fixed costs will remain constant, right? Fixed costs should not change so long as they are within the relevant range. And when we prepare the flexible budget, we are able to identify variances, which we're going to talk about more in chapter 10. Here's what a flexible budget performance report looks like. You compare the actual performance to the flexible budget. And then you are able to see if indeed the outcome was favorable or not. So actual plan was 220,000 units to be sold for $6,270,000. In actuality, we sold 220,000 units for 6.6 million. All right. So, sorry, the other way around, the flexible budget would have indicated sales at 6.6 million, whereas the actual sales dollars were 6,270,000. So now when we look at the sales dollars, we're actually looking at an unfavorable outcome, right? For direct materials, based on the flexible budget, the company should have spent $880,000 for direct materials. The actual direct material cost came in at 869,000. Now that is actually a favorable outcome compared to uh, what was or what would be permitted under the budget. So we will be learning more about variances in chapter 10. For the time being, just keep in mind that we prepare a flexible budget performance report to highlight the areas where there's a deviation from the budgeted norm. And those deviations could end up being either favorable or unfavorable. By way of a last example, we are going to look at example exercise 9-8. This is Lavage is a Canadian company that operates car washes. And we are given data about the company's costs. There are some fixed costs per month, and then there are some costs that vary for each car wash. The company charges $5.90 for each car wash. And we are asked to prepare a flexible budget, assuming either 8,000 or 9,000 cars are washed. So here we have a template for the flexible budget report. We're making this for the month ending October 30th. Don't know the year. So we'll have a column for the budgeted amount per unit. Here, the unit is each car washed. And then we're going to look at the number, the actual volume. So over here, either it's 8,000 cars washed or 9,000 cars. Um, so given the information in the problem, the company's selling price for each car washed is $5.90. So if 8,000 cars were to be washed at $5.90, 8,000 multiplied by the $5.90 will work out to $47,200 of sales revenue. If 9,000 cars were washed, on the other hand, then at $5.90 per car washed, the revenue will be $53,100. The variable costs for the company are, according to the problem, cleaning supplies of 70 cents for each car washed, 10 cents of electricity for each car washed, 30 cents of maintenance for each car washed, 40 cents in wages and salaries, and 5 cents for administrative expenses. So those are our variable expenses for each car washed. That adds up to a total of $1.55 for each car washed in variable costs. Now, if 8,000 cars were washed, the cost of cleaning supplies used will be 70 cents multiplied by 8,000 or 5,600. Likewise, electricity costs will be 10 cents times 8,000 cars or $800. Similarly, you can calculate the costs for maintenance, wages and salaries, and administrative costs. Works out to a total of $12,400. Now know that sales minus total variable cost is contribution margin. So for each car washed, if you have a selling price of $5.90 and the total variable cost works out to $1.55, we get a contribution margin of $4.35. If 8,000 cars were washed, our sales revenue will be $47,200 total. Total variable cost being $12,400 will imply a contribution margin of $34,800. From the contribution margin, we'll deduct the fixed costs. Now, what are the fixed costs given here? The company has a fixed cost of $1,400 for electricity for each month, $4,700 for wages and salaries, $8,300 in depreciation, $2,100 in rent, and $1,800 in administrative costs. So those costs are all fixed in nature, so they don't vary for each car washed. So if you add them up, you get total fixed costs, $18,300. Subtract the $18,300 from the contribution margin of $34,800, and at 8,000 cars washed, the company expects to earn operating income of $16,500. Now, if 9,000 cars had been washed instead, at 70 cents for each car washed, the cleaning supplies cost will be 9,000 cars times the 70 cents or 6,300. And that makes sense. The more cars you wash, the higher will be your total cleaning supplies cost. Similarly, your electricity costs will be higher, maintenance costs will be higher, wages and salaries will be higher, and the variable portion of the administrative costs. So in that case, our total variable costs at 9,000 cars washed will work out to $13,950. Subtract the $13,950 from $53,100, and we get contribution margin $39,150. The monthly fixed costs don't change. They'll stay at a total of $18,300. So of course, when we look at the difference between the contribution margin and the total fixed costs, if more cars are washed, then the operating income is that much higher. All right, so with this, we conclude the lecture video on chapter 9. In class, we will be going over case 9-29, and I encourage each one of you to pre-read the case before we take it up in class. Till then, take care. Bye bye.